Hello, this is Daniel Young, owner and founder of Adaptive Perspectives. Uh, this is another closed-end fund video. We'll be talking strategy, weekly picks, updates in general. Um, yeah, lots to go over. So I believe it's my purpose, my calling, to help you identify your dreams and help you reach your financial freedom destination and maintain it so that you can pass your wealth off to the next generation. Like I said, I'm continuing to show what I'm offering in the closed-end fund master, overall information, consolidation of data, what we own, how we filter the data, and then recommendations based on the filtered data. Reminders. It's an unedited video, so who knows what you'll hear in the background as I film these in my house. And I will be going over our financial freedom or our financial investment strategy of using closed-end funds instead of investing in single entity stocks. Um, Demonstrate how we filter, demonstrate, yeah, what we own, all the things like normal. Disclaimers. I'm not a financial advisor. I'm a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video. The complete transparency is we own the ones that are colored in blue, and I'll point that out. I assume no liability for your use of the information contained herein and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a uh, though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to, or because I have to say that, I also encourage you to not be afraid to walk your own path. I don't speak like the herd. I walk in very limited company, and sometimes I walk alone, and I'm okay with that. So let's get to sorting some closed-end funds, or really sorting funds, and see where this goes. Share screen. So here's the list. And there have been some updates. So if you note the tabs at the bottom, I've shortened out the past videos. Those are on YouTube as well. The tabs at the top say I still have a lot going on. So this is the complete list of all closed-end funds. And of note, or I guess the two notes, this amount at the bottom is shrinking because, for the most part, stock value is going up. You've got a couple funds paying less, but overall stock value is going up. So if this number stays fixed and that number goes up, that means this overall yield shrinks and that changes the average. So just as an example, so if ZTR suddenly goes back up to say like 6.5, just on this individual row, that number changes. And maybe it's not enough to change all of this. So let's make sure this data is correct. So it's the sum of, that's why, K3 through K440 divided by 440 minus 2 is 438. Yeah, still not enough to change it overall. So I like to sort and post videos by, oh, let's see, do video that doesn't like duplicates. That's today. This is from last week. Now we have a blank. Go to the master. Out of all these 438 funds, we just track these. And that number has since changed as well. It used to be around 100. Now it's considerably less. Let's see, this is off. So when I buy things, I like to know what we have. These are the trackers. So let's organize these reverse. Okay. 3 to the good night. All right, it's not going to do it. Wonderful. I don't know why it won't do it. Oh, there we go. Finally. Um, so the easiest way to screen these things is one, I don't have plans to buy anything different than what we already have. We're not currently adding to our portfolio. So, well, here, before we get into that, the easiest thing, first things first, it's finding out which ones are premium. So we don't buy premium. So USA will stay for now. And we're not adding anything new, which is why I'm taking out this one too. So I don't plan on adding anything new. So everything in light blue we own. Everything in green we track for one reason or another. Everything in purple is recommended by somebody else we trust. Our own parameters are up above. Well, they're normally up above. I'll go back and show you. Almost done. We need to go back and check out some things on that other list too. So if we look at this list alphabetically, this is how it appears. But if we sort it based on discount and then check the parameters at the top. So orange would be possible closed fund. Like it when I go through and update things, it's no longer there. Dark gray is a yield with less than 6.5 or a price over 16. So that price is under 16. That yield is over 6.5, so it appears as white versus this one. You'd have to actually click on the number to look at. But I really want to look at this discount section. So we track these for different reasons, but so DMA has a variable discount. DNIF has great funds, but I've been trying to stay, for the most part, above a yield of 9 when I make my own selections. And that varies to a degree. I mean, sometimes I pick funds with less. Um, but we started tracking that a while ago. We currently have a decent amount of what I would consider category 3 payments. So I really don't want to add a third one at the moment or another one at the moment. This pays annually. Yes, it pays amazingly, but it pays annually. And I don't want to be boxed into a corner of getting just, um, I don't want to be boxed into a corner of getting the yield once a year. FSCO is pretty new. Discount hasn't really changed. So of the list, I mean, there's 4 above it. That's still paying above its 5-year historical average. It's less than twice that now, but it's still significantly higher than the 5-year average. So that's still the greatest discount. And if we relate it to terms of money, if you think of a dollar as break even, so a dollar would have a zero. Um, so down, oops, let's scroll down this. So if you buy this fund for 752, you're not getting a discount. So every dollar you put in is a single dollar invested. Versus if you buy this, it's almost like getting uh 32 cents off your dollar for every share you buy. So instead of every dollar that goes in, instead of paying a flat dollar, it's like buying it for 68 cents a share. Versus if you go to the other end, um, that'd be like $1.52 a share. So instead of paying just the straight dollar to dollar at the premium level, you're paying $1.52 for every dollar invested. So just because it has a high discount to its net asset value doesn't mean it's doesn't mean it's a discount that we would target, which is why these targets help me further break down this list. So if we go over here, it's ranked based on discount. The targets are listed off the side. So it's a buy alert. So it's double or uh, close to double of its historical discount, but the easier number to track is its 5-year historical discount, or it's finally discounted below premium, and that's USA. 2 asterisks is a buy alert, just a general dollar cost average alert, and then 1 would be tracking. So um, I love this fund, but found out that it's liquidating, which is frustrating because I love this fund, but it went from 3 asterisks to 1 on Friday. AOD, people say will do well, hasn't really changed. AGD, that used to own a different company called DEF, they were bought out by AGD. I loved DDF. They paid special dividends. They paid fairly consistent dividends and paid better than AGD. But alas, it got transferred. Uh, NML, love the company, but the dividend has, say, the price has increased, the dividend has, or the discount has shrunk. Uh, it's a it's surpassed dollar cost average for us. And the reason why I have all these tabs, well, I can look at our current average. So these are all the times we've bought this fund, and likewise the others. Uh, what we've bought them at, etc. So that's our current buy price or average price a share. And NML is no longer a dollar cost average share price, and its discount has shrunk. So it gets 1 asterisk. KMF has a great discount, but last I heard, they're still getting bought out by KYN. And in the transfer of companies, it's not a 1-to-1 transfer on shares. So it gets the asterisk. NVXG, relatively new company. Prices risen above our dollar cost average. The dividend is pretty much the same thing it's been for a while. But since I'm a visual person, I'll show you. If this will actually load. We'll see if it loads. Cuba, it's deceiving. High discount, amazing yield, pays quarterly. I mean, low price overall, but has not been managed well. Um, they liquidated their funds and maintained the close. So they liquidated the assets or the holdings, maintain the fund, they have no current holdings. So I get a dividend every quarter that is automatically reinvested. So they pay me dividend based on what we have. So you can look over here, right? So every quarter we get that dividend, but then they take it back and in return give us more shares. And that's what that tracking number is. So the more shares over time actually decreases our overall buy-in price, technically. Maybe not technically, but so yeah, that's the best way to explain that. Which then increases our dividend the next time around, but I don't get the money back. So when you track that on here, I notate that we do get the dividend. And then I also notate that we get the shares in transfer. But strategy wise, there unless those funds are just sitting in a high yield account, it's not a great strategy. So we can take all of that off. USA for us is a great dollar cost average. That's in comparison, it's not. That would be good. That's a straight bond fund. I like this fund. Um, well, honestly, I like all of these funds for different reasons. I like this fund, uh, but if we're putting things in terms of the best deal for the discount, outside of me just liking these funds, I can pick these funds up cheaper than I can buy that one. As for the rest, so that still remains the top go-to fund solely based on discount. Um, if I wanted to screen past that, I mean, I could rank these. So I've been trying to go 9 or above, so I could get rid of FEI. And that said, its discount is greater than that 5-year historical average. But based on value, USA rarely dips into discount, so it'll stay. EOD, I track all of these funds. EOD normally sells for more of a, not premium, but it's recently dipped closer to that um, greater than average, so it makes the list. And here's where the fun begins. So FEI makes the list, but I like this fund better, and that's just me. So I would mix it from here. That's private equity and business development companies. GLO, it's a swing. Did this finally switch? Index sheet finally, no. Wonderful. So it's been around for about 2 years. It is a technology fund. Say so the average discount for about a year is 19, but if we tracked it for about 2 years, it'd be about the same. Currently, it's about 19. So there's no significant change in overall discount. Uh, yeah, the real fun begins. So of how I would sort these, more bank aligned, healthcare long-term great, but not the best value right now. Technology still seen as down, mixed bonds, and the swing of things. So let's look. So say bounce, 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 that. So this ZTR's got a better bounce pattern. Um, but yeah, gosh, now compared to even COVID, for what GLO has, it is a great long-term fund. Um, I just think with the bond market right now and the interest rates, it's dropping the fund overall. And that's my take. I mean, um, say average discounts probably around 11. On 5 years, it's been 8.5. Currently, it's at 16. Um, yeah, it makes my list. HTY is technology similar to NBXG, different payment scale, meaning that HTY pays quarterly, NBXG pays monthly. Waiting on internet. Video running fine. This not. Kind of strange. Can't explain. Could be the closed-end fund page itself. They have issues every now and then. Hmm. Yeah, last 5 years, so 2013 to about there, it's been about 7. But before there, a long stretch of premium with that deep stretch at the bottom. So it say -7, otherwise close to 0, if not premium otherwise. And currently at 13, that's pretty much double. So for the deal we get, NBXG has a great portfolio. So does HTY. But for the deal we get on discount, HTY, from my stance, is a better value buy than NBXG. IGR's real estate, ZTR. That's the other one I wanted to show you. We get nice swing point between highs and lows. So we're currently in another low. So between ZTR and GLO, I mean, the turnover is about 2 years for both. So from my standpoint, I can buy both, go back in here and show you. So they're both 3 asterisk targets based on discount. They're also great dollar cost averages for us. And they're both kind of on a 2-year curve. So it's not the buy and hold methodology, and it's not the swing traded every year, like a 20% gain, but it's a buy it low when I can. I mean, we already bought it higher, so it's buy it low when I can, hold it for about a year and a half or a year, depending on how the track is going, but hold it for at least a year, if not a year and a half. I could roll the dice and hold it 2 years, but hold it for a year and a half and sell it. And then I can bank the increase in, so I can bank the overall increase in value and bank the dividend, sell it, take that, and then buy something else. So if where I would go, pending what we had, uh, at some point we'll get the proceeds from GER, but that's not right now. So on overall discount, portfolio value, etc., HFRO still seems the place to go. After that would be oil. Oil's predicted to have another historic year. Private equity, yeah, all of these are good. I don't know if I can narrow it to four, but just based on the four of where they are, it would be that. It kind of depends on your strategy and what money you have. So strategy would be, what do you want to invest in? And when do you want to get paid? What dividends do you want to target? Um, a lot of people would say a portfolio with a higher dividend percentage is risky, and I would argue that it's not, unless you don't really know what you're doing. Um, People would argue that you want to be diversified, and I would say that's riskier than knowing what you want to do. Because if you don't know what you want to do, then diversifying is really just spreading your money out and hoping something takes off. Versus if you kind of funnel all of your money into targeted investments, you're better off. So I could buy a kind of all-in-one portfolio right here. If I wanted to target real estate, I would pick there. If I wanted to target technology, that's here. If I wanted to target bonds and other investments, that's there. If I wanted to target business development, if I wanted to target oil, if I wanted to target uh, real estate and data management and cloud technology, that's here. Um, EOD has an interesting portfolio. So CEF Connect will give you the top 10 of every fund's portfolio. If you wanted the top 25, then you would type in the ticker. So like ZTR, uh, type in ZTR Holdings white charts. Oh, nice. My internet or the website. Oh, there we go. But you could type in to pick your search engine. Type in the ticker holdings on white charts, and it'll give you the top 25 holdings of that ticker or of that stock or that fund. Um, EOD is tech heavy. Um, they've also got some bond funds, which may or may not have influenced price. But my caveat to EOD is it's been a fluctuating dividend and it's been a decreasing dividend. I mean, they've decreased the dividend the last three times, maybe the last four. I guess you could argue the last four times. Um, and that's kind of relative to the economy, but based on the others haven't changed dividends. So it's kind of really just goes back to strategy. If you want the best bang for your buck in targeted areas, you're looking here and there. If you want a great all around portfolio, that's there. Or a great all around, like USA gives me access to all of this stuff through just one USA purchase. HFRO does that as well to a degree. I mean, it's real estate, it's healthcare, it's data management, cloud service, but it's not everything that USA gives us access to. Um, so if you had, we'll say $500, you could come back and you could type in. Let's go back up one. I like things in sets of 50. It's easier on the math. But you could come back and type in how many shares you were looking to buy under $500 and see what your best outcome would be. So let's see. Like if you wanted to buy that, then you'd end up with 64. So you'd buy ZTR and FGB, and so at $500, right? So we could get that and that for under $500. We could also get that for under $500, right? So here's what you get for $500, or we could get that and where am I? That and that for $500, or you could get that and that for $500. But where are we? That seems to be your best outcome if you're trying for the greatest dividend. You're still playing to the overall discount, so you're still buying two funds at a great discount overall. You're below your buy price, right? So you don't spend the whole 500. You get equal shares of both. You get a monthly payer and a off quarterly payer. There you go. And you're generating more than 50 shares of the most heavily discounted fund. So it really does all depend on strategy as well as what you have. Does that kind of make sense? So reset all of those. If it's me, we just got a batch of HFRO, F, FGB, and it would still be a dollar cost average. So I get the best discount, great yield over 9, and a good DCA price. But if I could also kind of play into the swing of things with ZTR, so it's the same thing. I get a great discount relative to this fund's overall discount. I get a fantastic yield. It pays monthly, and I get a great DCA price, even better than HFRO. So it's not exactly a crapshoot. It really just depends on where you want to go. And since I don't have the capital to invest right now, it's honestly harder for me to pick what if scenario funds because I don't like we just bought something. I'm not going to buy something tomorrow. So if you're just starting, you need to figure out your strategy. And if you've been in the game but are looking for a closed-end fund and have never bought one, you need to know your strategy of what you want to do. Yeah, but outside of that, all of these funds make a great option. All of them make a great option. And they all make great options for their own merit. Like it's really hard to trim them down from here. But since I just got that, let's see, our average buying price with these two things being low and on swing, like at the low end of the swing, based on discount, based on dividend, based on price, based on everything, that would be my personal selection of what I would do next. And I get that, like, yeah, it's not the most heavily discounted, but it's in relation to their funds tracking. That's a fantastic discount and still a fantastic yield and a fantastic buy-in price relative to our buy-in price. But for us, this is where I would go. And if we had, say, if we had more, then I would go, man, yeah, I would start there or, yeah, because my thing is big on month. I love the quarterly stuff, but I really do just like consistent monthly payments. Um, but if I had to, so if I deviated from that and went quarterly, then I would go oil, tech, and private equity. So that's just me. Um, Stop the screen share, minimize that. So hopefully it just gives you perspective. My whole point of doing these videos is to teach you a strategy, closed-end funds, but also give you perspective on how to sort things. Like there's all this data. How do you sort it down and make it make sense? I took the time and went through all of those funds, and instead of, and I still do, I still listen to people who cherry pick funds because they give really good perspective and just overall advice. But I wanted to see the behind the scenes of how they're picking funds and the methodology for how they're picking funds. So I made the list of all the funds and took notes and did all the stuff. So it's a lot easier now to pick funds based on the last 2 years of doing this, but it's still a challenge. Um, like right now, there's no obvious, aha, it's this. Like you could say it's that way for HFRO because of the crazy discount, and it's still got a pretty near 10% yield. And for us, and probably a lot of other people, it's got a great buy-in price. You get the best bang for your buck based on just that. But it comes back to your strategy and what you want to do overall. If you're looking for the single best discount to, like, if you're looking just solely based on discount, just today, it's HFRO. If you're looking for the next 30 to 40 years, knowing what oil will do in the next year and knowing how much we'll need it in the next 20, 30, 40 years, then oil would be the great place to go. If you're looking at the interest rate world and knowing that we're not going to be stuck here at this rate forever, it's going to drop. And I don't think it'll drop tomorrow or next month. Me personally, I think it drops before the next actual presidential election cycle in September, maybe October, really September. Like once school for the most part starts again and people can pay attention to more stuff past summer, it'll be like, oh, the economy's better than what we thought it would be. And look, hey, we're going to drop rates. I think, yeah, I mean, that's the politics of all of that. But once interest rates drop again, all of these numbers are going to change. And every company who's got heavy bond investments and loan investment, all that stuff, it's going to change their numbers and jump their prices. So, yeah, and lower interest rates helps the housing market. Those numbers will change. Um, yeah, so it may, the maybe not the problem, the awareness you have to have playing the stock market is the stock market looks forward and you have to look beyond that. If you can see things long term, it gives you a much better perspective on what to buy now. It's like oil, we're still going to need it 40 years from now. So if it's cheap now, it's a great buy-in now. In closed-end funds, you get a fantastic dividend. You buy it low. So for the next 40 years, you get to collect the dividend, just watch it go up in price. And depending on your strategy, and you saw some of our strategy, but that master fund has the sell points for us on our tracking page. So based on like every fund's got its own sell point. USA for us, we don't have a ton of it right now, but the goal is long term. We'll hold it lifetime. Allergies. Um, we'll hold the USA fund lifetime. Eventually, we'll pick up shares of it. And even though it's on a dividend reinvestment plan, we'll still hold it. And as it does this, we'll still get paid a dividend. Um, yeah, no, I mean, seriously, like no plans to sell it. So we'll collect the dividend reinvestment program shares, and at some point, our daughter will inherit our portfolio, and she'll get to figure out if she wants to keep it, right, and hand it off or sell it at some point. Like if it tanks one day, if it drops to $2 a share, when everybody else is running scared, that's the best time to buy it. And if it skyrockets to $20 a share, then she could sell it and then buy something else with the proceeds. And then all of a sudden, USA drops to $4 a share. And yep, that's the best time to buy. So it really is strategy. Um, all right, that's all I got. So I don't want to ramble. So those are the top selections, which I know I didn't condense that down to four, but that's the best I got for right now. So if you like the content, consider subscribing to the channel. Head over to Facebook, join my group there called Navigate Your Finances. Facebook gives you the earned income and passive income strategy and really the playbook. And YouTube gives you the strategy for portfolio income and evaluating all of these mostly crappy financial memes. Um, and I have a page on Pinterest as well. So, pending platform, you'll find pretty much the same banner. But at Facebook, it's Adapted Perspective, Navigate Your Finances. YouTube is Adapted Perspective. Pinterest is Adapt Your Perspective, Navigate Your Finances. Um, yeah, join everywhere, see all the content, and you can kind of see where I'm going next. So remember, you're the captain of your ship. You have the power to change your life and your financial future. Many people, like all those financial memes, many people will offer to help you, but only you can make the choice to do it. Know what you're doing, pick your strategy, and go with it, right? Make it happen. Shock your world. And so much easier than what society says. So have a great week, and I will see you on the next video. Bye bye.